How's everyone going? Good? Enjoying it so far? Learning a little bit? There's a lot more to come. Normally what I do when I start up these presentations, I do a lot of education about psychology, because I really believe psychology is the key when it comes to investing. And I always say that when it comes to creating success, whether it's financial success or anything that you're doing, 80% of the equation is psychology, and then 20% is what I call specialised knowledge, which is all the strategies, all the stuff that you need to be aware of. Now the key is you've got to have 100% of the 20%. And then you've got to have the psychology and the drive to implement it. But because the finance section is so content heavy, there's so much mathematics involved and formulas and all this different kind of stuff, what I'm going to do today is I'm actually going to cover it before I go into psychology. So I'm going to hit you with all the mathematics, all that jargon, all that tricky stuff first, because that's really the most important thing when it comes to property investing. It's psychology is number one, but it's also the actual strategies. So that's what I'm going to do and start off doing that today. So I'm really excited to be here. I love coming to Queensland and Brisbane. It's funny how many Melburnians I meet up here. There's so many people from Melbourne here, you know. How many people from Melbourne that live now in Queensland? There's a lot of friends of mine that have moved. I mean, Melbourne weather is just crap, isn't it? Every time I come here, it's like, it's amazing. I go back to Melbourne, it's raining again. So really excited to be here, and I always try to squeeze in a few days and go to the Gold Coast and hang out with friends when I do events up here. The property market's been doing an amazing thing in the last 2 years. I'm going to go into a lot of detail about the property market. But really, honestly, if I look at the last, and I've been investing now since I was 18, I'm 33 now, not much has really changed in terms of the property market. Nothing. When I look at the investors that I've known for over a decade now who have established large property portfolios of 30, 40, 50 properties, really their psychology and the methodology has not changed. It's the same pretty much regardless of where they are in the cycle. Yes, they do alter different things, and I'm going to talk about those today in a lot of detail. But really, you know, a year ago, we were seeing a lot of articles talking about how the whole property market's going to collapse. Dr. Keane was saying that 40%, the Australian property market's going to crash by 40%. And was he right? And what did he have to do? Because he made the bet. Who's read the article about Dr. Keane now having to climb Mount Kosciuszko in near Canberra there, wearing a t-shirt? I was wrong about the property market, ask me why. Now, I love every time there's a property cycle, the media does the same thing over and over and over. There's a bubble, it's going to burst, everyone's going to lose money. The interesting thing is that the best time to invest in property was probably in late 2007, when the subprime hit the hardest. And this is where I was negotiating with developers directly, getting $50,000, $100,000 below valuations on blue chip properties, because developers were under pressure by the banks, they were getting squeezed, they were scared, they were buying into the media hype, and that's why investors go in hard and get the best deals. Now that the market's recovered, the sentiment's back, is it a really good time to invest in the property market now? It is, but you can't get the bargains that I could have got in 2007, 2008. Those bargains are gone because the property market has recovered. We've got references now on the properties going up in value. People have, like for example, in Melbourne, the last 3 months, Melbourne median price went up by $70,000. Last year, the average person that owned a house in Melbourne made $766 per day in capital growth. That's amazing, isn't it? That's more than most people earn in a week. So it's always a good time to invest in property. And I'm going to go into extreme detail today. I'm going to show you exactly what you need to do to buy property and establish large property portfolios. I'm going to get into product-specific knowledge. So it's not going to be just concepts. I'm going to say, go to ING and get this particular loan. It's going to be that detailed. Now, the way I've structured the 2-day event is this. It's a free event, and you can sit here basically for 2 days and not do anything with any of our companies. We're going to have a lot of different speakers talking about finance, accounting, all different services that we offer as part of the 21st Century Academy. But at the end of the day, you can just come to this event and literally just get educated over 2 days and do nothing with any of our companies. Okay? Do we want you to become our client with finance and accounting and insurance? Absolutely we do. But you don't need to become our client. That's the thing. And there's really no strings attached. Now, when people say free event, they automatically think, what's the catch, right? No such thing as a free lunch. Well, this is going to be a free lunch because the contents that I'm going to give you today and tomorrow, I think is worth thousands of dollars, tens of thousands of dollars. If you implement it, it's going to be worth hundreds of thousands of dollars to you. And I've been going to property seminars for the last probably 12 years. I've spent easily over $100,000 on property seminars. And I've taken the most important bits and pieces that I've learned over the years and taken bits and pieces from my background in finance and banking. And I've really structured the information in such a way that it's very user-friendly. So we're going to cover some fundamentals, we're going to cover product-specific information, and by the end of today, by the end of the finance presentation, you are going to know exactly what to do and how to buy a lot of property. Okay. Now, the most interesting about building large property portfolios is that people always think that their income, their PAYG income, has a lot to do with how many properties they can buy. Who thinks that way at the moment? I'm going to show you why your individual income is virtually irrelevant in terms of your ability to grow and build a large property portfolio. Virtually irrelevant. It's only important for your first purchase. But after that, your individual income doesn't come into the equation. And this is probably the biggest misconception around. And I'll show you the actual calculations that banks use to assess your borrowing ability and how they actually assess your ability to borrow money, what they look for. I'll show you the exact formulas they use, and I'll get you to understand how to play the game, what the rules are, and how to win. Who agrees that you need to, in order to win at a game, you need to understand all the rules? And that's the thing I'm going to teach you today. I'm going to teach you from the inside how the banking system works, how they assess you, and what you need to do in order to build a large property portfolio. So in terms of what we're going to cover over the next 2 days is basically we're going to cover a lot of knowledge over the next 2 days. We're going to give you very fundamental knowledge about property, about how to build and structure large property portfolios, how to make sure that once you're building them, you've got the right, insurance or risk management measures in place. Because there's no point building a house on quicksand, would you agree with that? So you've got to make sure that you understand how asset protection structures work, and you've got to understand that when you're building your property portfolio, whatever happens if you get sued, that you know how to protect your assets. That's what I'm going to show you today. Okay, so basically we're going to go through an investment plan. We're going to talk about finance and how the finance industry works. I can tell you now that people always think the finance industry is changing. There's been nothing new in finance since Citibank introduced a line of credit into Australia in the late 80s. There's been no new products. It's the same old stuff, just repackaged, rebranded. People always think there's new stuff happening. There's been nothing new, and I'm going to show you exactly what you need to understand about finance, meaning what products are available, which lenders can give you those products. Warren Black is coming in later on today. Warren Black he's an accountant, he's a solicitor, he worked for the ATO as an auditor for 10 years. So he knows a little bit about property and asset protection and accounting. He'll be talking about structures and how to maximise your asset protection structures and also minimise your tax. And we've also got insurance as well. And then tomorrow we're going to focus pretty much the whole day on property due diligence. We're going to do macro level analysis of the market, and then we're going to do micro level analysis. So my goal is really, by the time you leave here on Sunday, you will know exactly where to invest, what street to invest in, what type of property, zoning, size, and why. Who'd like to learn that? Very tangible knowledge, and that's all you need to know. The 2-day event is structured in a way where there's nothing, you can always learn more. I'm learning every day, and I've been doing this for a long time. But I can tell you now, there's nothing else after this 2-day event. This is it. So there'll be enough knowledge for you to take away, and Monday start investing, going to real estate agents, going to the banks, restructuring your finance, and basically start building a large property portfolio. So what I want to teach you today is a couple of very important distinctions. Probably the most important thing I'll teach you is why finance is the reason you invest in property, and property just happens to be the wealth creation vehicle. So property is not the actual thing that's going to make you money. Let me give you an example. And this takes a long time to actually realise, and it took me probably about 6 years in the industry to understand this. Let's say we've got 2 properties. We've got property A, and this property is growing at 10% capital growth. Let's say we've used RP data and we've looked up the last 10 years of that suburb, and you've got a rental yield of 5%. And this is property A. Property B is growing at, let's say, 7%, and it's got a rental yield of 5%. If you had to make a choice between property A and property B, How many people would choose property A? Yeah, it should be the whole room, right? How many people would choose property B? 7%. Why would you, correct? But let's say you go to the next level. Now let's say you've got limited funds, and with property A, you've put a 20% deposit in to buy this property. And because you're putting in a 20% deposit, let's say it's worth $500,000. Okay, so you're putting in $100,000 to secure the property, and you've got about $25,000 in stamp duty, legals, and closing costs. So you pretty much all you could buy is one property. But let's say with property B, because it's an outer area property that's been on the market for a long time, and because you got educated, you structured a vendor finance deal, meaning that you've structured a deal where the vendor left 20% in the property. And because you didn't need to use a deposit to secure the property, all you need to do is have the funds to pay for the stamp duty and the closing costs. With your $100,000, you've secured 4 times $500,000 properties. So now you're controlling an asset worth $2 million. Here you're controlling an asset worth $500,000. 10% after 12 months, let's have a look at the results that you're having. The first investment, okay, it's $500,000, you got a 10% capital growth. What's 10% of $500,000? $50,000. But here, because of your skill set and education, and because of vendor finance, and I'll go through vendor finance tomorrow when I teach you how to buy property with no money, you've got 7% growth on 2 million. What's 7% on 2 million? How much is it? 140,000. So which option is superior now in terms of results? B. But yet B is an inferior property to A. You see, an advanced finance strategy will virtually always override any property selection strategy. Okay, so most people, when they look at property, they're always obsessed with getting the best property, the spillover suburbs, buying the worst street, the worst house in the best street, all that kind of stuff. But when I look at advanced, sophisticated property investors, over time, the property selection doesn't become important anymore. What becomes very important is the structure and the deal. Because when you look at property, you can break it down as simply as this. What are you starting off with today? And what results will you have in 10 years from now? And the stuff in the middle is just strategies. So if your objective is to create $3 million worth of equity in 10 years' time, it doesn't particularly matter which properties you invest in. All that matters is that you know exactly what you're doing and you know how to structure those deals to get you the outcome that you want. Who understands that? So there's hundreds of seminars out there and books that will teach you how to buy the best properties in the best streets, and I'll talk about spillover suburbs and all that stuff tomorrow as well. But what I want you to understand is it's the finance that is the most important thing. It's understanding deal structuring and finance and leverage that's going to make you money in property. It's never going to be the property itself, because you end up buying 1 or 2 properties over 10 years. That's not going to get you the results. Now, if you look at stats in Australia, it's an interesting thing about property market in Australia. 82% of properties in Australia are owner-occupied. Sorry, 72%. 8% are government-owned, and then 20% are investment properties. Okay. Now, if we take that 20% of investors, 80% of investors only have one property, and they've purchased that property within 3 to 5 k's of where they live. Just to keep an eye out for it, because it could run away, There's only about 5% of the 20% that know how to get to 5 properties plus. Obviously, they know something different than the other group. Would you agree with that? The most important thing to understand, it has nothing to do with their income. It has nothing to do with their income. Now, I'll talk about my background, but when I used to work as a financier for the National Bank, I used to look after high net worth individuals, doctors and dentists, and I used to do commercial lending and asset finance. Some of my clients, their income per year was probably in excess of $300,000-$400,000. Some of them got up to $500,000, especially some of the dentists. But the amount they actually declared each year, was it $500,000? No. What would their accountants do? Minimise the amount of income they declare. It will be about $30,000 to $50,000. because they would use all their businesses and all the other structures to buy their cars and pay for all their assets. So remember, from a lending perspective, how is it possible for a person to have 40 properties? Do you know how much money you have to declare every year and earn to secure and service 40 properties or debts of 40 properties? It's virtually impossible, and I'll show you the formula that's applied. So the first thing, just going back to the PowerPoint, number one thing is the only reason you invest in property is because of finance, no other reason. And the reason we choose property is because the banking system allows you to borrow up to 95%. You can still borrow 97% with Bankwest today, which is the highest lender, okay, against property. So it's got the highest leverage. And that's the only reason we choose property. I'm going to show you why structure is far more important than the interest rates. The interest rates are virtually irrelevant in the equation, okay? So it's an interesting thing. I'm going to really challenge some of your belief systems, because when I started in property, the most important thing to me when I was 18 was property selection and the interest rate. And I can tell you now it's the least relevant thing, which is property location and the interest rate. It's all about structure. And I'm going to clarify that in detail. Now, what I mean by structure is LVR, LOC, and terms of conditions. Now, let me just clarify a little bit of jargon that exists in the industry. There's a lot of jargon in this industry, probably unnecessarily so. And I want to keep things very simple. I'm going to assume that you guys have no knowledge about property, and I'm going to go from level 1 to a very advanced level. So LVR, let's say you've got a property worth $500,000 and you've got a mortgage worth $300,000. What's the loan to value ratio on this property? Anyone? It's 60%. How do you get that? It's 300 divided by 500 times 100. So loan to value ratio, it's the ratio of debt versus the asset. That's all it is. When you think about the terminology, LVR is actually a flawed term, because LVR is a ratio, it's a 1 to 8, but it's always written as a percentage. So they haven't thought it through very well, have they? It's either a percentage or a ratio, can't be both. Now, a line of credit is like a giant credit card against the equity in your property. Now, generally speaking, banks will lend you 80% without lender's mortgage insurance, and we'll talk about LMI later on, against the value of the property. What's 80% of 500? 400,000. So what's the difference between 300 and 400? It's hard mathematics, isn't it? So a line of credit is basically like a credit card that allows you to take out $100,000 from the equity of this property, and you can spend that money any way you like. Now, recently there have been limitations set in place by different lenders in terms of how much cash out you can do from properties. 3 years ago, you could have cashed out any amount up to 80%. Now, some lenders have set a restriction. Could be $100,000, could be $200,000. Okay, but if you take that $100,000 out of this property and you go out and blow at the casino, or buy a car, or buy an investment property, will the bank ever call you and ring you up and tell you to repay that $100,000? No. What's your only obligation on that $100,000? The interest component. If you're paying 8% per year, how much would you be paying every year for that $100,000 while it's outstanding? $8,000 divided by 12. So the most important thing with a line of credit is, as long as it's 80% of the value of the property, you never ever have to pay it off. The banks want you to stay in debt. They don't want you to get in trouble or fall behind with your minimum repayments, but the banks want to keep you in debt just so you just manage. Because the banks are in the business of selling money. Now, they don't want to lose their money, so they have various criteria that they use, and we'll talk about that today, in terms of how they assess risk, but that's really what the banks do. So I'm going to show you why structure is the most important thing when it comes to property investing, meaning that the best vehicles to buy property don't have the lowest interest rates. You need flexibility and you need different structures, so you're never going to get the product that has the lowest interest rates. Products with the lowest interest rates have the least amount of flexibility. And I'm going to show you why interest rates don't even exist, and they're irrelevant, okay? I'm going to show you how to pay off your current 30-year principal and interest mortgage and reduce it by 15 years or more without even doing anything special. Okay? Now, how many people in the room currently have a principal and interest home loan? Okay, and keep your hand up if you've got a really good relationship with the manager that gave you that loan. I can tell you now, after lunch, you're going to take him off the Christmas list. I'm going to show you how to turn a negatively geared property into cash flow positive in 30 to 60 days. And this is with a product. So, you know, the funny thing is that a lot of people are making money in property now because interest rates are historically low, but they're going to go back up, okay? You need to know how to make money when interest rates are 8, 9%. And the rental yields are 3.5%, 4%. Because that's what the reality of the property market is. So if you're just making money in this market, I'm telling you now, this is going to change because this is not the normality of the market. If you look at the historical data, and we'll go and look at historical trends, interest rate trends and the property market, property cycles. So I'm going to teach you how to make money when you're buying properties and you're paying 9% and your rental's 3%. If you can do that, then you can do anything else. Would you agree with that? So there's some properties now where they're getting 5% rental yield and getting 6% funding. Well, anyone can make money in that market. That's not a skill at all. So I'm going to show you how to buy these properties that are negatively geared, meaning all properties in the major capital cities, in the blue chip suburbs, are all negatively geared, and I'll show you why. And I'm going to show you how to target these blue chip properties to maximise capital growth. And I'm going to show you how to sack your boss, take 1 year off to pursue your business endeavours. Who'd like to do that? Okay, so who's 21st Century Finance? I'll just give you a bit of background about our company and what we do. We're basically, we're mortgage brokers, number one. We're not your typical mortgage broker. That was the guy that was working there when I started. I got rid of him. We're basically, how many people in the room are Academy members, meaning they've been to a 4-day? Okay, great. So 21st Century Finance is an internal service division for 21st Century members. We don't advertise externally, we don't need to. We've got these events all the time. In fact, this weekend, we've got 3 events at the same time. So you can imagine the amount of seminars and events that we run, or workshops. We have so many clients coming on board. We don't do any external advertising. We just purely capture the internal clients. That's all we do. The reason we've been set up in the first place is because we teach a lot of different strategies, a lot of advanced strategies about making money through the share market, you know, futures market, internet businesses, etc. So if you go out into the real world with dealing with real mortgage brokers, most of them will have no idea what you want to do. In fact, I've had clients come back to me saying, Konrad, I went to my mortgage broker, I told him the stuff that you taught me at the seminar, he says it's all crap, it's BS, you can't do any of it. So I said, well, give me the phone. I ring him. After 12 minutes, he rang the client. Yes, it's all, yes. Look, I didn't know we could do that, but yes, you can. So I'm going to show you the stuff that brokers don't know how to do. I know because I've hired and trained them. I've been training them for a long time now, and I've got to teach them all that stuff. Remember, to become a mortgage broker today, all you got to do is Diploma of Financial Services brackets broking, which is a 4-day course. They don't teach you everything in that 4 days. Who'd agree with that? Yeah. So there's stuff that you got to learn. 21st Century Finance specialises in unlocking equity. The most common thing we do is basically refinancing properties and getting lines of credit out for you guys to buy more property or do share trading or invest. That's pretty much what we specialise in. Also, restructuring finance. A lot of clients come to us and the banks have cross-securitized everything that they have because that's the cheapest way for them to buy the next property, and that's what the which bank has recommended. So they come to us, and then we've got to unencumber all your properties, which is very, very messy, and it takes a long time to do so. It's very expensive. So we fix a lot of stuff that managers do at banks for our clients. So I'm going to teach you about cross-securitization. I'm going to show you all the things that you should never do under any circumstances, which are common industry practices now. And I'm going to show you why they are this way, why the banks do what they do. Accessing better rates. We've got over 36 lenders. So sometimes if we can't fix your structure and you've got really good products and you've got you structured correctly, if we can do anything, we'll just match the rates or we'll give you a better deal on the rates. Okay, and I'm going to show you products where you can get up to 0.92 off the standard variable rate. And I'm going to show you how to do that exactly. Any day of the year. Doesn't have to be through us. It can be directly to the bank. And also we do a lot of creative finance. We've done vendor finance with developers that we deal with. We've done solicitors funding. We've done a lot of different things that the normal mortgage broker just won't do it because it's too hard. They don't know how to do it. So that's basically what our company does. My journey. So I came to Australia when I was 9. We immigrated from Eastern Europe. Any immigrants in the room? Great. I'll tell you something interesting. If you've migrated to the country, and if you had a very, what I call humble, growing up, you're quite poor, which is what I was, you've got a very good chance of becoming wealthy. If you were born in a wealthy upper class in Australia, which really doesn't exist, but if you're born into money, you've got a very good chance of becoming wealthy. If you're middle class, the odds are against you. And that's the reality. Australia has the biggest middle class in the world. 70% of roughly Australians are middle class. And most of them don't do well financially because the school system doesn't really teach us about money, does it? And part of our culture is to be a bit cynical, right? So then there's the other aspects as well, which we'll talk about in the psychology section. But basically, that's some of the things that keep us where we are, which is, and I'll show you the stats and I'll show you the reality of where most people end up. So we migrated here from Eastern Europe, from Poland. Both of my parents are engineers, like all the other Polish migrants. And the way my parents were bringing me up is this: if you can't afford to pay for it in cash, you can't afford it. Who's got parents like that? And what they did was they worked their asses off as soon as they got here to buy a house. And they bought a house in Bentley, in Melbourne, which by the way, 15 years ago was an okay suburb. Now it's semi-blue chip, it's near Brighton, which is a very good suburb. And then they spent 15 years paying it off. Now, over that time, the condition that they have from their parents is that all debt is bad. And they've spent a long time getting rid of all their debts. They're the kind of people that never use credit cards. If they need to buy something, they save money and buy it for cash, And that has kept them where they are, which is one property, but no investment properties. And I don't think they'll ever buy investment properties because the conditioning they've had over the years is just too much to break down. So when I actually started going to school, my parents told me what you got to do in order to become successful in Australia is you've got to go to school, go to high school, go to university, get a good job as a lawyer, a doctor, or a dentist, make a lot of money, right? Which is not the reality of the situation, is it? So when I got through high school, I did a business degree, which is a 4-year degree, and I can't say it was a bit of a waste of time. And then I got into managed funds because I figured, how do I become wealthy? Because I really wanted to become wealthy because of our bringing up was quite, we were quite poor when we grew up. And we lived in St Kilda in Melbourne. By the way, in the 80s, St Kilda was absolute crap. Not the St Kilda of today. Now it's a very trendy suburb. But back then, it was a very average area. It was probably the worst area in Melbourne. And I figured, I'm going to become a financial planner because financial planners deal with wealthy individuals. And that's what people at the university were telling me. If you want to become wealthy, become a financial planner. So I got into managed funds. And I started working for a company called Australian Unity Funds Management, which is a blue chip big company, been around for a long time. And I was doing my diploma in financial planning, financial services, and I found out very quickly that most financial planners are just salespeople that sell products off a recommended list. And in fact, they have no assets behind them, and if they quit their jobs, they'll be out on the street within 3 months. So I left that industry. And I figured, well, how do I get to these wealthy individuals that have all these properties? So I got into lending, and I got into commercial lending and asset finance. And eventually, after years of working in that industry, I got into a very niche area of commercial lending. And what I was doing in Melbourne is setting up medical clinics and dental clinics, and only looking after doctors and dentists. So all the information I'm going to teach you today about how to build and structure large property portfolios, not only have I been doing it myself, I'm actually doing it for other clients. But I've learnt all this from clients that have been doing it since the 60s and 70s. So this is not stuff that I've invented myself. I'm not creating any of this methodology. This has been around for a long time. The psychology and the way they structure and build these property portfolios has been around for a long time. The problem is no one's really teaching it. And these guys don't have the time to go out there and educate people on how to do it. They just do it themselves. So, people talk about the secrets of the wealthy and the super rich. I don't believe there are any secrets. But what I do know is that most of the dentists and doctors and wealthy individuals that I used to look after, they have access to consultants like Warren Black, and these guys know stuff that the average accountant doesn't know. And most of them are investors themselves as well. So they have access to consultants that the general public doesn't have access to. And it's because of those consultants. When I say consultants, I'm talking about accounting, financial planning, definitely solicitors, and real estate agents or advocacy experts. And they're the people that I've spent a long time with, and all this stuff that I'm going to teach you today, I've learned from them. So I'm not taking credit for any of the information I'm going to share with you. I'm just taking stuff that I've learned in the industry, and I'm giving it to you today. So I've worked in asset finance. I was doing radiology equipment for $1 million and lasers for hospitals, and eventually I was doing extensions to hospitals. Now, by the way, working for NAB, in Victoria, there was only really 7 people like me that did what I did, that specialise in this niche area. I found out very quickly that you can do something in lending called outside of policy lending, which means that you can break rules. I'll give you an example. I financed a commercial building in Albert Park, which is a veterinary practice, and I did an unsecured commercial loan at 90%. It was actually a little bit higher than 90% unsecured. Now, is there any commercial mortgage brokers in the room? No? There's one? They'll tell you it's impossible, right? It's 70%. Would you agree? Well, it's there. You can go and drive and knock on the door and say, what was the LVR on the property? And they'll tell you. That was completely outside of policy. Okay, and I was going to talk about outside of policy lending, and I'm going to explain the most important thing about property investing is that you've got 2 options when you're getting a loan. You can deal with a mortgage broker, or you can go directly. And I'm going to show you when you should be using the mortgage broker and when you should never use a mortgage broker, and why. And when your relationship with the bank actually matters, and what stage of the property acquisition stage you should be doing different things. And that's a very important thing. Eventually, I got into property and I built a large property portfolio and also started trading. And the problem that I had was that all my properties were slightly negatively geared, or I had no cash flow coming out of my properties. So what I had to do is create cash flow. And that's when I went on a journey of learning how to trade options. And it was a very painful 5-year journey of losing a lot of money. And I won't go into that today, but I will mention it at different stages tomorrow of what I did and how I'll link it back to property. But basically, I got to the stage eventually where I found a company that was actually doing what it was supposed to be doing, meaning that the traders were actually making money trading. And I started to slowly match my income every month by trading options. And eventually got to the stage where I was making more money trading than I was working as a financier for NAB. And I said to my wife, this is insane. And by the way, when you work as a financier, you're working 60, 70, 80-hour weeks. You're working Saturdays, Sundays. You're delivering mortgage documents on Saturday night to their houses. You're doing whatever it takes to get the deal. This is not a 9-to-5 kind of a job. This is like all the time. So eventually, after years of having the asset base behind me and doing option trading, got to a stage where I replaced my income. And eventually, I was making twice the income from trading than I was working in the banking industry. And I said to my wife, this is insane. You know, I'm only trading 3 or 4 hours a week, and here I'm doing 70-hour weeks. She goes, what do you want to do? I said, well, I want to quit. She goes, well, why don't you quit? So I quit. And I did nothing. Now, when I say nothing, I mean, I went from working 70 hours to doing absolutely stuff all. I was getting up at 10, 11 o'clock. I was watching Jerry Springer. Watching Pimp My Ride. I didn't want to go out to Africa and build schools. Not that there's anything wrong with that. I don't want to go and save, the rainforest. I wanted to do nothing, okay? All I did was watch DVDs, go to the gym, and just hang out with my friends. And honestly, if you could replace your income and double it, how many people would just do absolutely nothing for at least a year or two? I'll be honest. Yeah, absolutely. Now, there's a lot of different speakers that, they do all these wonderful things, but I'm not at that stage yet. Give me another 5 years of nothing. Well, now actually I'm working more hours than I was in private banking, which doesn't make sense. Eventually I met Jamie McIntyre and Shireen, and I was asked to start up 21st Century Finance, which I did. So I was basically recruiting, training all the mortgage brokers, helping to set up the aggregation. I'll talk about that as well. But eventually, because it was only residential lending, I got bored. And by June 2008, I wanted to basically step away and go into another area of the company, which I did. And that's when I set up 21st Century Property Direct. And 21st Century Property Direct, number one, is an unbiased educator. Full stop. Number two, we have services like property sourcing, which we'll talk about tomorrow as well. But number one thing that we do is just educate people. And because we offer all the services in the academy, we do quite well with the education, because once people get educated, they go and use our mortgage broking services, our insurance, etc., our accounting, etc. So now all I do is I look after 21st Century Property Direct. I don't look after finance anymore, even though I've co-managed and hired most of the brokers there. Now, we have access to over 30 lenders. They're the lenders that we have access to currently. We aggregate through Plan. Plan is the biggest aggregator in Australia. Now, let me just show you the problem with the industry. Now, do you want me to give you the information through, it's all warm and fuzzy, it's all great, or do you want me to give you the reality? Yeah. You sure? I can feed you the BS that it's all great, everyone's an expert. No? In 2008, I had a meeting with the BDM of Plan, and he showed me, the business development manager, showed me the commission payouts for all their brokers. Now, they're the biggest aggregator in Australia. They have 3,500 brokers that look after them. And roughly, this is what it looked like. Out of 3,500 mortgage brokers, the top one was making about 1,016,000. So that's 10 per year, working from home. He had full-time assistants. There was a number of them at the top, I would say about 7 or 10, that were making between $1 million and about $750,000. And then there was a massive gap, there was a drop. And there was a couple here at 500, there's a couple picked up around 350, 280, and then there was a massive drop again and picked up at 160. So there was just a few mortgage brokers out there, I'm talking about all of Australia, that were making really impressive money. This is the reality of the industry. 95% of mortgage brokers make less than $60,000 per year. That's a loan and a half per month. This industry, ladies and gentlemen, is filled up to the brim with people that are completely incompetent. They rise to a level of incompetence they're comfortable with, and they stay there indefinitely. I'm talking about Wizard, I'm talking about Mortgage Choice, I'm talking about everyone. Meaning, out of the 30 lenders, they use one or two lenders. They have a relationship with NAB or CBA. They use a couple of other non-conforming lenders, like could be Liberty or could be Pepper Home Loans or a Bank West, and they do the same loans over and over and over because they get paid the same commission. They have no incentive to learn all the credit policies of all the lenders and what difference it would make to place you with different lenders in different order, because they're getting the same money. So the problem with this industry is this. You guys are going to Wizard and all these different brokers and aggregators thinking I'm getting a real expert here based on your branding perception, but you're dealing with a person that knows how to do 3 or 4 loans, and they do them over and over and over. And property investors wonder why they can't get over building a large property portfolio. If you can get to these guys here at the top, these guys really know what they're doing. They really know their business, because most of their business comes from referrals, word of mouth. They don't do a lot of advertising. But the reality is that when you guys go out there, you're getting the 95% club. And these guys have no idea what the hell they're doing. No idea. I know because I train them and I recruit them and I interview them. And I ask a broker 5 questions and I really eliminate 90% of them. 5 questions that I ask a mortgage broker. Most of them can't answer any of them. And to do with lending. And I'm going to share some of those questions with you today. So you're going to know more than the average typical mortgage broker. Access to 30 lenders, they're the 30 lenders that we have. Now the interesting thing is now, because of the subprime, these are really the only lenders that are really lending at the moment. Okay? Meaning that you can work with them. Some of them are coming back to the industry, but for a while these are the only lenders that we had because of the subprime fallout on the industry. Now, let me give you some background on banking, and this is quite relevant. Generally speaking, in Australia, lenders get their funding from 2 different sources. Number 1, it's something called balance sheet lending. Number 2, securitized funding. Now, balance sheet lending is when banks open up or create saving facilities and term deposit accounts, and the public parks their money there. and they lend it out to the public at a high interest rate. That's called balance sheet lending. Comes in on one side of the balance sheet, goes out on the other, okay? Now, the major four banks, ING and St. George, are balance sheet lenders predominantly. They rely on Australian money and they lend back Australian money. They still rely on to a smaller extent, on securitised funding, which is buying money from overseas money markets, pension funds and fund managers in the US. The ones that rely predominantly on securitised funding, which is Macquarie, for example, okay, people like that, they're out of business. Because what happened to the cost of funding overseas? It went up. This is the reason why Macquarie pulled out of the market. So if you're relying on banks that rely predominantly on balance sheet lending, which is the major four, plus St. George and ING, you're going to get better rates and more flexibility from them compared to the others. As a full doc borrower, okay, we'll talk about different types of lending. The others are finding it too difficult to create products because the margins are gone because of the cost of funding. Now, they're going to come back into the market, but I think it will take some time before they recover. Now, what's the purpose of dealing with a mortgage broker? And I'm going to give you a real scenario. The advantage of dealing with a mortgage broker is that we do the research for you. We have access to over 1,500 loans. We put your financials into a spreadsheet or a software package that is provided to us by the aggregator. And we basically can access 1,500 loans. If you go to St. George, can they talk about NAB products? No. They only talk about St. George products. Where what we do is, based on what the questions that you ask, the mortgage broker, we can give you the products that you're after. So this is one of the most important distinctions that I'll cover today. Your success as a property investor, to a large extent, is determined by the types of questions that you ask your mortgage broker. So you've got to ask the right questions and point them in the right direction for them to give you the right product, because they're just human beings. The more clarity you have about what you want in the product, the more clarity they'll have. Would you agree with that? See, the thing is, no one's going to make you wealthy apart from you. You've got to do it. So you've got to get educated so you can have a good conversation with a mortgage broker and know exactly what to ask for and why, because he won't do the research for you. Remember, they just want to get the money. They just want to get the 0.1% and move on. Doesn't matter which product they place you in. So you've got to have enough information so you can have that conversation with a mortgage broker. I'm going to show you what to ask for and what to look for. So that's the only reason you go for a mortgage broker. High level of professionalism experience, operate under strict code of ethics, efficient, smooth, etc., etc. Now, why would you ever not use a mortgage broker, and why would you use a mortgage broker, and why would you ever use a bank, and why wouldn't you use a bank? I'll give you a very simple example, and I'm going to cover this in detail. Let's say you're going to the Commonwealth Bank of Australia, and CBA has one of the best products on the market for property investors. It's called the Wealth Package. And I'm going to talk about the Wealth Package and how it's structured. But when you're starting out in property investing and you're uncertain about which products you should take up, I'll give you the 4 top products that you should be looking at, which is the Professional Property Package with NAB, the Wealth Package with CBA. But let's say you've got your owner-occupied property, and then you've got your investment property. And they're standalone properties, but they're in the Wealth Package with CBA. And you're going for your second investment property. So this is investment property number 1. And you want to buy a second investment property. If you go with the Commonwealth Bank, the way they assess your ability to buy your next property, even though the interest rate could be 7%, interest only, they actually work out the serviceability, which I'll show you in a second, based on 9% principal and interest. And that's how they determine the maximum that you can borrow. But if you go to the National Bank, in order to finance your second investment property, the National Bank would only use the real interest rate that you're applying for. Okay? It's the same thing with going through, for example, if you've bought one with the National Bank already, and CBA, you're going over to the CBA, then they're looking at your other investment property with the National Bank. They'll actually take your real monthly repayments and deduct them from your income that's coming in. Your income is based on your income plus rental. But if they're doing a loan with the Commonwealth Bank, they always assess The assessment rate is always 2 to 2.5% above whatever rate you're getting, and it's always principal and interest. End result, your second investment property with CBA, they could come back and say you can only borrow 350, but with NAB they could go to 500. Is that important to know? It's also important to know that the order of which lender you go through will determine how much you can borrow. Meaning, let's say you've chosen 3 lenders, ING, CBA, and NAB. Depending on which order you apply for loans, because of the serviceability calculators, they'll give you different amounts that you can borrow altogether. Let's say your intention is to buy 3 properties. It could be the difference between 3 properties at 1.2 million to 2.5 million, just because you went in a different order. Isn't that interesting? Most brokers don't understand that. And there's no software that analyses the relationship between the order of which application you go through. Is that important to know as an investor? Very important. What's the cost in opportunity of not buying a property with $800,000 over 10 years? It's massive, isn't it? Just for a little bit of information and education. So let's go through now. What I'm going to do is I'm going to go through step by step on teach you a little bit about lending criteria that all the financial institutions look for, and I'm going to go through the formulas that I'd actually use to assess your buying ability. So I'm going to do all the kind of boring finance, math stuff now, and then we'll talk about all the fun stuff later on, which is all the property stuff, okay? But we've got to get through all this crappy stuff now, which is the boring bank stuff. But this is probably the most important thing for you to understand, because it is to do with finance, and at the end of the day, the more knowledge you have in this area, the quicker you can build your property portfolio. Bless you. Loan assessment criteria. Now, normally, if you anyone here worked for a bank before in lending? Yeah? How thick are the credit policy manuals? Yeah, like that, right? So I took that and condensed it down to 4 slides, okay? which was very difficult to do. So basically what I've done is, I've come up with an acronym called SLICE. And SLICE stands for security, location, income, character, and equity. And these are the 5 things that all lenders in Australia look for when they are lending you money. It's pretty much the same across the board. There's slight variations. Number 1 is security. Different security classes determine different LVRs and interest rates. So different types of property have different restrictions and maximum LVRs placed on them. And I'm going to go through them in detail. First of all, we've got residential versus commercial property. And this is very important to understand. Now, let me just show you, being commercial lending, there's a lot of things that people don't understand about the differences between commercial and residential property. The most important thing to understand is the valuation process. Because the most important thing to you as a property investor is for you to control the valuation process. And I'm going to spend an hour on this tomorrow. See, most investors wait for the market to go up. What I do as an investor, I create the market. I'm going to show you how I do it tomorrow. So I don't particularly care what the suburb does. All I care about is comparable sales and controlling the valuation process. And I'm going to show you step by step on how to do that tomorrow in detail. The biggest difference between residential property and commercial property is the valuation process. So if we look at the valuation process on residential property, how do valuers establish the value of a residential property? They look for 3 comparable sales or 3 properties that were sold in the suburb within the last 6 months within a 10% price point. So if you're valuing a $400,000 property, they look for 3 other properties around $400,000 that sold in that suburb in the last 6 months. The valuation can actually come in within a 10% price point. So it can come in anywhere between $360 and $440. At 21st Century Finance, I have seen variations of up to 20%. So we've got 3 swan valuers. One does, on the $500,000 property, one does 400, one does 500, one does 600. And you can borrow against all 3 valuations. And all valuers are on the panel of all lenders. Isn't that interesting? So the beauty of the property market is it's such a fragmented, inefficient market. If you know how to exploit it, you can make a lot of money. It's the inefficiencies in the market that make it so attractive. Things like controlling the valuation outcome. With commercial property, the value was established, the value of a commercial property, based on the lease, not based on comparable sales. So if you've got a $400,000 commercial property, they will look at the terms of the lease and the tenants and value the property accordingly. And the biggest difference is that with residential property, they don't look at the rental, because the rental vacancies around Australia are what? 1%, 1.5% in major capital cities? Virtually irrelevant. So the reason I invest in residential property, not commercial property, is because I want to revalue my properties every 6 months and create more equity. And I'll show you exactly how I do that using RP data and buying comparable sale reports. So tomorrow I'm going to teach you how to do that. So there's no other reason why I invest in residential property, just because of finance, leverage, and controlling the valuation process. So if you go back to the screen, let me show you different classes and how different classes of property determine different criteria. So we've got residential houses, townhouses, units and apartments. Now, how safe is residential property as an investment? Well, I'll give you an example. Now, what's the worst suburb in Brisbane? What is it? Let's pick a Melbourne. Why don't we just do that? When I ask this question in Melbourne, by the way, this is not my answer, this is the audience answer. People always say St Albans. So if you go to National Bank, let's say NAB, who would agree that NAB is a fairly blue chip company, yeah? They make a lot of money, they don't take a lot of risk. If you go to NAB and say, listen, I want to buy $100,000 of NAB shares, unsecured, what's the highest loan to value ratio that you're able to give me? What is it? It's about 70%, 60 to 70. If you go to NAB and say, listen, I found this property in St Albans, it's between a petrol station and a drug rehab centre, right in the middle, and there's power lines behind it. I think it's going to make a really good investment because it's the worst house in the best street. How much will you be able to lend me? 90%, historically up to 105%. So think about this. The banks, they make money out of hedging risk. They don't take risk. They have entire departments just analyse risk. They're telling you that based on their assessment of this particular asset class, they're willing to lend you 70% against their own shares. This is with full transparency and full financials, right? Because they know what they're doing. And they're willing to lend you 90 to 105% historically against the worst property in the worst street in the worst suburb. So LVR is not only the, and write this down, LVR is not really the maximum you can borrow. LVR is the assessment of the underlying assets, ability to fluctuate in value, medium to short term. Isn't it really? They're telling you the NAB shares can drop in value up to 30% short term. That's why they capped it at 70%. What are they telling you about residential property at 90%? There's only a possibility of dropping by about 10%. In the bullish market, they're willing to give you more than the value. That's how safe residential property is. And I've been speaking now for 2.5 years, and I've always been saying in the media, and what I do is I collect articles, and I've been collecting articles now for over 10 years, written by academics and different journalists predicting the property market's going to crash. And I'll collect them. I read the Fin Review every day. I've got a whole book just filled with beautiful articles from 10 years ago, predicting it's all going to crash, everything's going to come down. And I sometimes, what I've done, this is my hobby, I sometimes correspond with those people and have discussions about when they're predicting this crash will occur so I can be there to snap up all the properties. But really what happens with security, and this is the thing, everyone's got an opinion, but I would say this, your opinion is as valid as anyone else's, but who's right? Is it NAB or is it Dr. Keane? Well, I would say the person that's right is the person with the most amount of money behind them. Would you agree? So unless Dr. Keane is worth more than NAB, that's the way I look at it. Because if they were wrong, they wouldn't have the amount of profits they'll be making every year. They'll be losing money, but the fact is they're making money. So when you're buying property, most financial institutions have to some extent already assessed the risk of buying that property. So units and apartments, okay? If you've got an apartment less than 50 square meters, there's a lending restriction against that property, 60% LVR. What are they telling you about that property? Yeah, Gold Coast high-rise apartments have a lending restriction of 60 to 70%. What are they telling you about those properties? Is it a good investment? What about Quest Service Departments with rental guarantees for 5 years? 50% LVR. What are the most profitable companies in Australia telling you about Quest Service Departments with rental guarantees? Don't go there, yeah. So the first filter you should use as an investor is work out, is there a lending restriction against the type of property that you're buying? If you can borrow 90% against that property, especially above 80%, which means that lenders, LMI and insurers have assessed it, I'll talk about LMI in a second, it's pretty much a good investment in terms of its risk profile. But that's the first level of assessment that I use as an investor. What about service departments? What about rural property? Over 100 hectares. Can rural property sit on the market for 2 years? Yeah. Absolutely. So when they say we're going to be lending you 50% against rural property or 60%, what are they telling you? Yeah. So they're giving you their opinion about the liquidity of the asset and the risk of the asset. So before you buy property in the open market, especially if it's an apartment, if it's a house, it's got a land component, normally not a problem. But the first thing you should do is ring up a financial institution and find out if there's a lending restriction against it. If there is, walk away. It's that simple. Turn to the person next to you for 30 seconds. Explain the concept of security LVR and the property and how it's assessed for you by financial institutions. 30 seconds. The second thing we look for is location. By the way, the last one there was commercial property, which is 70% LVR. Because especially in economic downturns, commercial property, because businesses can go under, can they not? You lose the tenant, the property can drop up to 30%. Very easily. In fact, I've seen drops up to 50% on property, especially commercial property that's purpose-built, that's got a restricted market. So that's number one thing is security. The second thing is location. Location of the property will also determine LVR. There are postcode restrictions. If you're ever buying a property and you're uncertain about the location, and I'll talk about locations, and this is relevant for house and land as well as apartments. Okay, because house and land, there are places where you should never invest in house and land estates because there are problems with those estates, and I'll talk about how they are sold, how they are marketed, and the inherent problems with them. Some are great, some are really good, but there's a few that you just stay away from. If you're ever buying a residential investment property, what I would recommend you do is go to the following website, which is www.herringtoddwhite.com.au. Anyone working for Herring Todd White here? I had a few people in the last seminar. Yes? You used to? Great. It's probably the most conservative valuer in Australia. And when I say conservative, they're the benchmark for valuers. They've got a presence in every major capital city. They do a lot of research, and they're on the panel of most lenders. So if you're buying a property and you're not sure about the location of it, I'll give Herring Todd White a call and just say, look, can you do a valuation on this property? Or I'm buying this property in the street. What do you think of the area? They'll tell you if there's problems with the area. They'll tell you if there's any postcode restrictions. Now, remember, in banking, in lending, banks don't know what the property's worth. So what they do is they rely on valuers to give them a valuation on that property. Now, valuers, or companies like Herring Todd White, Charter Kramer, WBP, all these companies most of them are privately owned companies, and they have valuers who look after a pocket of suburbs. So these guys might look after 3 or 4 suburbs, and that's all they do. They do 3 to maybe 8 valuations a day, and a lot of them, because of the industry doesn't have a lot of, I guess, once you're a valuer, you're pretty much a valuer forever, right? They don't move around a lot in terms of career, because it's a very specialised area. So once they become a valuer, they look after a particular area for a long time, and because of the volume of valuations they do, they become experts in those areas. That's why when I do research and due diligence on suburbs, the first thing that I do is I ring up a valuer and I tell him I'm a professional investor. I'm looking at a cluster of 3 suburbs. Let's say it's, for example, Matone, Cheltenham and Balmoral. I'm going to be ordering 10 valuations from you over the next few months because I'm looking at all different properties. And this is like $1 million tip here. In your opinion, can you tell me the best and the worst street in that area and why it's the best and worst street? Do you think a valuer who all he does is does valuations will tell you automatically which street in that suburb is the best in terms of resale value and the worst? Yeah. So every suburb has a street that's better than the rest of the suburb. Would you agree with that? It could be the trees, whatever it is, and you don't know if you're an outsider. You have to live there for a number of years, and you go, that's the street that has the highest resale value. And there are always streets that have the worst reputation in some suburbs. So the best way to find out where they are, rather than you doing a lot of research, is just ring up someone that just does it for a living. So your relationship with the valuer is very important as a property investor. Postcode restrictions. Postcode restrictions occur because valuers, when they do a valuation, they are liable for that valuation indefinitely. Okay? They have indemnity insurance, but they are liable for that valuation indefinitely. So their valuation, if they say it's 400, if something happens 2 years down the track, if it sells for 300, the banks can go and sue the valuer for the difference. So they're not conservative at all. They're just realistic and informed. I wouldn't say, people say, oh, they're conservative. No, they're realistic, they're informed. And the other inefficiency with valuers is that each valuer, when they look at comparable sales, they only use the company's database. And the company's database, which a lot of them use RP data, doesn't get updated as often as it should. Meaning there could be sales in the market 3 months old, but they're still not appearing on the database for whatever reason. I've got developers that I'm working with where they've sold properties in key areas where even RP data doesn't know they've been sold because they haven't told anyone about it, just private transactions. Wasn't an agent, was developer directly to the actual client, and they haven't settled yet. They're still off the plan, no one knows they've been sold. So this is why there's an inefficiency. Different valuers use different databases to draw comparables. And I'm going to show you tomorrow how you can influence the valuation process, which is the most important thing you can learn as an investor. Postcode restrictions, a number of things occur. Let me just give you an example of Melbourne and Docklands. Okay, it's the same thing as Gold Coast. In fact, you guys created this whole industry in the Gold Coast in the late 90s, early 2000s. Where people used to fly in, right? Melburnians used to fly up. It was funny because Queensland properties were marketed in Melbourne, Melbourne properties were marketed in Queensland. I often say, if it's so good, why does it need marketing? Like, do we ever market St Kilda or Port Melbourne in Queensland? No, because the moment they list, they're sold. So let me just show you how this works. And this is exactly the same as it happened in the Gold Coast, happened in Docklands. Let's say you've got a tower in Docklands, which is 150 apartments. Now, normally, this tower is going to be built on a block of land. The blocks of land are usually 4,000 square metres, 6,000 square metres. They're not actually that big. So if you've got 150 apartments, what's the land component per apartment? It's about that size, isn't it? And we know that land appreciates, buildings depreciate. I wouldn't use it as a blanket rule against all properties because that would mean St Kilda shouldn't have the capital growth that it does, okay? But as a rule of thumb, it does work, and I'll talk about more of that tomorrow. But let's say you've got 150 apartments in Docklands. It's a brand new tower that's being built and it's being sold off the plan. Normally, in order to get the finance, the developer needs to pre-sell at least 60% of the apartments off the plan. And then the banks will give him the finance to start building. And most developers, what they do is they start off small, doing small projects. 3, 4, 5 houses, 10 houses, 15. And then suddenly they work out, gee, if we just do 100, it's the same thing, but we're just adding more zeros to everything. But what they don't realise is the property changes from an owner-occupied product to an investor product. And what you guys should never do is you should never invest in properties that are designed for investors. So if you want to lose money in the property market, just type in Google property marketing companies, ring them up, and just buy those properties. The best way to lose money quickly. Or just to sit on something that's not going to give you any capital growth for years to come. So you should only target properties that are built for owner-occupiers. Because remember, 70% of the market is driven by owner-occupiers, not investors. Investors don't drive the market. So they pre-sell 60% of these properties. The moment they pre-sell 60%, they get the funding for the whole project. So in Melbourne, they were doing this in the 90s, and this is what they were saying. There's a marketing company, I won't name names because they're getting recorded. If you come to my live events, I'm naming names, right? In the late 90s, there was a marketing company that used to say, listen, Melbourne's been growing at 10% for the last 40 years, and this is the RP data report. This is a 4-year settlement we have here. This is 98. we've got a 4-year settlement. Rather than putting cash down, why don't you secure it with a bank guarantee or a deposit bond? They're $500,000. And you don't have to settle for 4 years. And you know what? If you don't want to settle, just sell it in year 3. At 10%, you're going to make at least 150 grand. Why wouldn't you do it? And that's what people did. All these investors went in and they started securing these properties off the plan with deposit bonds and bank guarantees, which I'll talk about tomorrow. I'll talk about deposit bonds and bank guarantees. In 2002 and 2003, what they didn't know is a couple of things. Number one, the valuers, when they looked at this project, they didn't like it because they didn't like the fact that there was 150 investors in that particular project with virtually zero owner-occupied component, which means they're all competing for the same rental. And if anything happens, by the way, most of these properties now are sold in overseas countries, to Asian countries. I'll talk about why in a second. So valuers go, you know what, if we value this at 500, let's say something happens in the economy and they get sold, what will happen if there's 150 identical properties on the market at the same time? Yeah, it might devalue. So we're not going to give 500, let's go conservative, let's go 400. By the time they were ready to settle, most of these properties, the valuations came in at 150 below contract. The other thing was that the lenders' mortgage insurers, which I'll talk about in a second, it's the next slide, they said, you know what, we've got too much exposure to this project at above 80%, so we're going to cap our exposure to 30% of the project. Meaning the first 30 people that go through on finance, they can borrow above 90% and 100%, but after 30, we're not doing any more. So we are rejecting all lenders' mortgage insurance after the first 30% of properties. So you get 150 investors getting pre-approval, a letter of pre-approval 3 years before saying you can borrow 100% to buy this property with lenders' mortgage insurance, not realising that the LMI underwriters, which is GE and PMI, have already made a decision only to approve the first 30%. The rest are getting rejected. What happened in Melbourne was these properties today are still 500. People had to sell the houses to move into these properties because they couldn't afford to lose, so they had to sell the residential property, which went up in value, and move into these apartments because they didn't have the 20% deposit. And the valuations came in at 400 and lower. So, because there's 35 towers to go in Melbourne Docklands, the developers got smart and the marketing companies got smarter. They say, shit, we've burnt the Melbourne market, right? We've burnt everyone here, we've burnt everyone in Queensland. Why don't we go to overseas? So this is what they do now. They go overseas and they say, listen, we've got this beautiful tower in Docklands, Melbourne. The most livable city in the world. It's the same pitch in Queensland, Gold Coast. We've got migration, we've got 1,000 people coming in every week. We've got population growth. They go to an Asian country. Now let me ask you this. In Australia, do people live in apartments predominantly or in house and land? House and land, right? Because there's so much land. In Asian countries, do people live in house and land or apartments? Apartments. Are the apartments fairly small? So what's their standard cultural belief, value system? Where do most people live? Yeah, apartments. So when they go and say, listen, we've got these apartments with water views and they're 13 squares and they're $650, where they're living in a 8 square $1 million apartment, do they think that's a good value, good deal? Yeah. And they say, look, Australians are fairly slow, they haven't caught up with this yet. And this is such a good opportunity. We went all the way to Singapore just to give it to you guys, because we want to look after you guys, because we're interested in your future. So they pre-sell 60% to overseas investors. And a lot of overseas investors pay cash for these properties as well, because they target the market really well. They come back to Australia and they say 60% pre-sold, getting quick. And this 40% could take 3 years to get sold. It just sits there forever. If you want to go to Lorimer Street, Docklands, have a look at the sales office. Just sit there forever. It's the same properties I've seen 3 years ago. Now, this is the problem with the properties. You've got 150 identical properties. You've got one tower there. Let's say each property is 13 squares, and let's say you've got 600 mil stainless steel appliances, and you've got a car park for each property. What happens if next door there's another tower that's being built? But this tower has 250 properties, but it's got a swimming pool and a gym. And all the two-bedders or one-bedders, let's say the two-bedders, they're 14 squares, and they've got higher, superior fixtures and fittings. And because of body corporate restrictions, you can't actually alter the size or the shape of your property, can you? You can't just say, listen, I'm property number 213. Can I come in and just redo the whole property? Would you guys be happy with that? What do you reckon developers are going to tell you? No way. It's, it won't be pretty. So imagine you've got 150 properties in this tower. You've got 250 in this tower. If you've bought in this tower and this is a superior tower with better views, and you're competing for the rental market of a tenant, are you not competing first with these 250 properties before they look at your property? Yeah. So your competition is not even in your tower. It's all the superior towers that are up and coming. If builders and developers are building tower after tower, are they going to make the towers worse or better with more facilities, with storage facilities and 2 car parks per property? Yeah. So they get better and better and better. Let's say this tower has 60 or 70% ownership in an Asian country. If anything happens overseas, and you've got a person in an Asian country with their owner-occupied property and an investment property in Australia, and suddenly something happens in their economy, like the Asian currency crisis, which property are they going to sell? The one they live in or the one they invest in? So what happens if there's 60 to 100 identical properties in one tower on the market at the same time, and they tell the agent, just sell, I don't care what I get? Do you see how many problems there are with these towers? It's just the worst investment you can make as an investor. It's just problem after problem. I can do 2 days just the problems of these towers. Okay? Just don't invest in them. It's that simple. So, now, statistically, tomorrow I'll talk about stats, because there are lies, there are damn lies, and there are statistics. So don't believe all these 10% capital, all this stuff. I'll talk about that tomorrow. The same thing, though, has happened in Melbourne with house and land estates. Okay, and I'll show you why. Because it's not so much that these are towers, it's the inherent risk with buying one of these properties. You guys understand? It's not so much it's a tower, whatever it is, it's just that these people, these valuers, and these underwriters of lenders' mortgage insurance, they've been around for a long time. They've seen the property. That's all they do. All they do is underwrite risk in property. And they know that they don't want to lose money. So they know it's not so much it's a tower, it's the inherent risk of that property. Meaning there's a lot of identical properties that could appear on the market at the same time, and that's when you lose value. Now, let's talk about house and land estates. There are good ones and bad ones, and I'll talk about these more in detail tomorrow. But let me just show you one estate in Melbourne. It's an area called Trigonina, which is actually west of Melbourne. Nothing wrong with the area. But it was a combination of different scenarios that for the first time, valuers started to devalue house and land packages. Meaning they were coming in 20, 30, 50 grand below contract, which I've never seen before in the lending industry. How a house and land package is created and marketed. This is what happens. You get the big developers like Delphin or Landlease or Australand, and they go to a farmer that's got all these acres and acres of land that he bought for peanuts in the 50s and 60s, right? It's not residential one zoning, but it's near enough to infrastructure, and because Melbourne's expanding, it's the same thing in Ipswich and the growth corridor here, okay? It's exactly the same thing in all major capital cities. So they've got these blocks of land. So let's say they've got this parcel of land, and what marketing companies do, they cut it up into blocks. Do they release 1,000 blocks on the market at the same time? They do stages, don't they? So they cut it up into different stages because they don't want to flood the market. So what they do is normally they option the land from the farmer, and they do a joint venture, meaning that the moment they sell the land, that's when he gets paid. So they secure it with nothing, virtually. He's happy because he's got a big developer and he'll become extremely rich. So let's say we're looking at subdivision number 1. There's subdivision number 1. If you want to make money in good subdivisions, this is why people camp out in stage number 1. Because stage number 1 is always the cheapest. Because they test the market. They don't even know what it's going to be selling at. So let's say, in this example, they're selling blocks of land at $100,000. Okay? And they're going to see, we'll see how quickly they sell. If they sell really quickly, we'll put it up to 150. If they sell slowly, we'll put it up to 120 in stage 2. Okay? The truth is, and I know the sales managers of these companies, they don't know what they're worth, trust me. I've seen them I've been in meetings where they're trying to establish what we should sell them at based on comparables. Stage 1 sells quickly, they go, you know what, let's do stage 2 at 120 or 130, but let's say that it just sells well. And this is what they tell you, listen, this area is booming. We've just sold 100 blocks, stage 2 is already selling at 120, that's already 20% capital growth in 5 months. Which is true, isn't it? People go, shit, it is. Look, 100, 120, that's 20%, right? Stage 3, 130. Stage 3, they go, listen, this area is booming. I was selling stage 1 8 months ago for 100, now it's 130. That's 30% capital growth in 1 year. Where else would you get that in Melbourne? And they go, you're right. And you got the sales. Look, there's 100, there's 100, there's 100. Can you argue with that? Stage 4, stage 5, stage 6. Now, stage 7, 8 could be selling for 180. It could be 2 years later. Now, there's a problem with these estates, and this is the problem. It's to do with demographics, the type of buyer that's buying it, and when they were buying it. What actually happens is most people now can't afford to enter the property market in Melbourne and buy an established property because the median price is $590. Okay, so first home buyers, even if they got good incomes, banks just won't lend them that much money. So they have to get in somewhere. They either buy an apartment or they buy an estate just outside of the city. Would you agree with that? Because you can get in at $300,000, $400,000. So you usually have a brand new first entry or a person that's just entering the market. Also, the first home buyers grant and the kickback from the developer who were matching these grants made it very attractive for first home buyers because not only were they getting all that money depending on which type of grant they qualified for, they were getting cash in hand as well. And because they were first home buyers, all these blocks of land were being built and all these houses were being built at the same time. The problem was they were roughly the same types of properties. They were roughly between 380 and 420. So once again, you've got a very similar problem like you have with apartments because you've got the same property being built over and over and over and over. So you're not the product is a little bit different, right? Different walls, maybe you have 3-bedroom and 4-bedroom, but it's not like 1,200,000, right? Which you have in established suburbs. What happened was this particular estate was sold very quickly because it was the closest estate in Melbourne to the city, and it was sold within a 12-month period, pretty much to the same type of person, which was a person that's just entering the market in the workforce for a few years. Interest rates were very low, 5%, 5.5%. The scary part was that the cash that they were getting from the developer, they were using some of that money to pay for their mortgage as well. And this is at the lowest point in the market historically when the interest rate's at the lowest point. So valuers said, you know what, we've got a problem here. We have 800 houses that were sold roughly in a 12, 13-month period of time, roughly the same price, roughly to the same demographic, who roughly work in the same industry or industries. And if unemployment goes up, which is what everyone was predicting, remember the Rudd government was saying it's going to hit 8%? We're going to have a problem because if this couple, one of them loses their job, they're going to put their house on the market. And also the biggest problem was the secondary market of buying these properties, because this is why these properties don't do well in terms of capital growth. And I'm going to show you now. Property prices are determined on the secondary market, not the primary market, meaning that no one knows what a house is worth until it's listed with an agent and it's sold. Would you agree with that? Because this is price controlling. This is not capital growth. So let's say you've got a couple. Why would you buy a $400,000 new property off the plan versus a $400,000 2-year property? Let's have a look at the pros and cons. Number one, if it's off the plan in Victoria and you usually get a 450 square metre block, you only pay stamp duty on the land. You don't pay stamp duty on the house. So your stamp duty will be about $15,000. Say actually about 12. If it's 2 years old, you're paying stamp duty on the entire property. So we're talking about maybe $22,000. There's already a $10,000 saving. Do the styles change in 2 or 3 years? Does Metricon and all the other developers, do they come up with different styles continuously, different feature walls, different design? They do, they upgrade them, don't they? So you've got stamp duty. Number 2, do you get a higher first home buyer's grant if you buy off the plan and build versus established? Yeah. So the first home buyer's grant is also different. The other thing is, why would you buy a 2-year-old property if you can just go 50 metres up the estate where there's endless blocks available? Like what's the advantage of you buying a 2-year-old property versus a brand new one? So what's the secondary market? Is it very strong for that particular person that wants to enter, or would they just go straight to the developer? Plus what developers were doing was they were matching the first home buyer's grant, weren't they? So it's lower here and they're not matching the first home buyer's grant because you're buying from a person that's already bought it a few years ago. If you're an investor buying it, your depreciation, which we'll talk about tomorrow, we've got a quantity surveyor talking about depreciation. Your biggest depreciation is on the building, which is over 40 years at 2.5%, but also on your fixtures and fittings. And your fixtures and fittings have a lifespan of about 5 to 7 years. So why would you buy a 3-year property? We've already given up 3 years of depreciation. We can buy a brand new one, cheaper, and maximise the depreciation on that property. So for investors, it's not an ideal investment either. So the secondary market was bad on these properties. It wasn't attractive. And what ended up happening was that St. George came out and they said, you know what we're going to do? We're not going to lend any money in this suburb at all. We'll stop lending on this suburb. And that's what they did. And for a while, you couldn't get any funding for those particular suburbs. So if you're going to buy a house and land estate, what I would suggest you do is buy one that is bolted onto an established suburb. So you've got a cluster of established suburbs. Let's say there's a city, hypothetical city. This is your established area. Is it better to buy a house and land estate here in the middle of nowhere, where you've got virtually endless amount of land, or is it better to buy one that's bolted onto an established suburb where there's no more land left so you can utilise all the established infrastructure of that suburb? Who'd agree? Makes sense, doesn't it? You've got schools, transport, shopping centres, brand new estate, there's no more land here. This is the first one that's tagged onto the established group of suburbs. That's going to give you more capital growth than buying one in the middle of nowhere where they have enough land to subdivide for the next 100 years. It's common sense, isn't it? Valuers are aware of this, and this is why there's postcode restrictions. So getting back to the slide, postcode restrictions. If you're buying a property, the first thing you should do is ring up the valuer and find out, are there postcode restrictions on this property? They'll tell you. Because when valuers know there could be a potential to have a huge amount of properties on the market at any one time because of different economical events or trends or property cycles, they will do a restriction on that postcode. And this has to do with high-rise, it has to do with house and land, and it has to do with student accommodation. Because there are places around major capital cities, near universities, that have restrictions because there's a huge amount of units or student type of accommodation, which also are volatile in nature. If you target just your typical suburban house and land, your metro property, around the median price, around the major capital city, 5Ks to 35, but not the city itself, because the city itself doesn't do well, you'll be fine. That's when you have the least amount of lending restrictions. Turn to the person next to you just for 30 seconds. Explain the importance of location, postcode restrictions, house and land, towers. 30 seconds. Okay, coming back. Thank the person next to you. So what I'm teaching you here is I'm teaching you a logical way of looking at the property market. I'm teaching you the primary filters. The first filter was LVR, based on the risk and the liquidity of the asset. The second filter is location, postcode restriction. How do you assess these two risks? Valuers. Income, PYG versus self-employed. This has to do with you and in terms of your ability to borrow money. So generally speaking, in Australia, when you're making money, you're getting paid either as a PYG employee, or you're self-employed, or you're director of a company paying yourself an income. Now, And this is the kind of documentation that you also need to prepare if you are going for a loan or want to become market ready. So if you're a PYG, you need 3 pay slips, you need 2-year tax returns or 2 years worth of group certificates. If you're a self-employed, you need to be registered for GST, even if you're making below the threshold. If you're self-employed, you're not registered for GST, very difficult to get a loan as a low doc borrower. With a low doc loan, and I'll cover all the loans after lunch, low doc loans are virtually gone from the market, okay? What you need now is you need 2 years worth of BAS statements. So, and I'll talk about different types of loans that are still available. If you're self-employed, you need to have an ABN, GST registration for 2 years. Now let's talk, we've got to be careful what I say here. Still filming, are we? Sometimes people forget to register for GST, don't they? So when they ring up the ATO office call centre, could you say, listen, I should have registered for GST 2 years ago. Is it a possibility for you to backdate my GST registration? That could hypothetically happen, would you agree? In some cases. Company structure. If you've got a company structure, a director, you're paying yourself an income. You need 2 years income, assets and liability statement, structure and directorship. So pretty much these are the kind of information that you need. Also, if you're an employee, you need to be past your probationary period. They're usually required to be in the same job for 6 years. They prefer for you to be in the same industry for 2 years. Also, if you're getting a pay rise, get the loan before you get the pay rise. Pay rises are bad from lending. So if you're getting, we had a person before last month that was applying for a loan. He's an engineer. He got a $100,000 pay rise. He goes, guess what? I got a $100,000 pay rise. I got a letter and everything. My pay structure's changed. I got the first paycheck. I said, you can't borrow any money, buddy. Because from a lending perspective, you're a manager now. You're in a different role. There's more risk. You could get fired. He thought it was good. It's bad. So pay rises are not a good thing. Big ones in a short period of time. Lenders don't like them. It means there's more risk now on your profession or your job. 5, 10 grand's fine. 50, 100, bad. So income is very basic. Now, character, clear history. I'll bring this up very quickly. Just before we go for lunch, I'll cover character and we'll have a break. Every time you borrow money in Australia, whether it's a personal loan, residential loan, commercial loan, apply for a mobile phone or broadband internet connection, there's a credit reporting agency called Vader Advantage. And Vader Advantage is a privately owned company and they hold a file on every person in this room. Now, because you haven't signed a privacy consent form with Vader Advantage, they can't actually stipulate on your credit file whether you were successful in your application for a loan or not. So if you go for a loan on Monday with St. George for $500,000, they'll just say on your credit file that on the 1st of February, you applied for a $500,000 loan with St. George for investment purposes. That's all they say. They can't say if you were successful or not in your application. Your credit file is the most sensitive part of the lending game. Because if you have any hits against your name, whether it's you've missed and it's little hits, Telstra, or OneTel. Is it NoTel? Yeah. Anything like that you get recorded against a credit file, lenders will check it. And if you have any adverse hits, it will limit your lending ability. Now, couple of things. Number one, ring up 133124, go to mycreditfile.com.au or Vader Advantage, get a copy of your credit file. It's a free service. If you pay for it, like $40, I think they email to you the next day in a PDF document with a password. But you can actually get a free credit file. You just have to wait. You've got to fill out like all these forms and wait for a month. If you're a serious property investor, go on to My Credit Alert, which I think is about $45. I've been on it for so long now. It just comes out automatically once a year. Anytime anyone marks any of your pages on your credit file, you automatically get that page emailed to you. Now, a couple of things. Number one, let's say you're shopping around for a loan. You're buying a $500,000 property and you're going to all these different lenders and you're getting pre-approvals. Anytime they mark your credit file, okay, so you go to St. George, you go to Bank West, CBA, you got 3 hits so far. You just want to know what your options are. Anytime they mark your credit file, the next time you apply for a loan gets a little bit harder, especially if you haven't taken up the loan. If you get 8 hits in a 12-month period of time against one loan and you haven't taken up the loan, you can't borrow money for 2 years. You're out of the game. Because lender number 9 says, well, this guy's going for a loan for $500,000. He's got 8 hits here for the same loan. He hasn't taken up the loan. What is it about him that we don't know, that the others know? So you got to make sure that if you that's why you got to deal with a mortgage broker that understands your specific financial needs and can submit the loan to the right lender in the first instance. What you want to do is, what I do is this. You apply for a loan and you make it subject to satisfactory credit file check. And you include a copy of your credit file that day saying, this is a copy of my credit file. I'm a professional investor. I do loans and refinancing all the time. I don't want you to mark my credit file. If you need a copy of my credit file, I can get a copy for you any day because your requests don't matter. They're not marked on the system. But if they open up your credit file, it automatically gets marked. Now, you want them to mark your credit file despite the fact that you've told them not to. Because that's when you say the words ombudsman. That's when you really can negotiate your position with the banks. Because he said, guys, I told you not to mark my credit file. Here's a letter from my solicitor. You've done it. Now he's going to stuff everything up. What discounts can you give me on the interest rate? Interesting thing. We are filming this, yeah? I've got to be careful what I say. Let's say you're buying 3 properties in the same development. You've only got serviceability for $500,000. You can only borrow $500,000. And you're buying the same 3 properties in the same project. If you go from 3 different lenders, CBA, NAB, St. George, and it's the same price of the property, let's say it's $512,000. And it's the same address of the property, but it's 3 different townhouses. You can settle all 3 as long as they settle on the same day, because all the lenders will think, can't say anymore. If you didn't understand that, turn to the person, well, do it at the break. It has to be the same price, okay, because it's the way it gets recorded in the credit file. If it's 3 different prices, they say, well, it's 3 different properties, we're not going to give you the loan before settlement. But if it's the same price property in the same address, okay, it's still so much money, people that got it, you can settle all 3. Even though technically you can only settle 1 for 500. Might have to edit that out. Because I want to have the ombudsman ringing me. So bottom line is, you've got to have a copy of your credit file. If you find a mark on your credit file, be upfront about it. Just write a letter saying, I was on holidays. I didn't know that Telstra was chasing me. We moved out of that property. Substantiated, be upfront. Remember, anytime you go for a loan, they will check your credit file. You can't get away from it. But there's one lender in Australia that only checks 1 out of 3 loans on the credit file. And it's the which bank? So you might get through. You've got a 33% chance of getting checked. I'm giving away all the stuff here. So you got to make sure that, and this is how the system works. Now, we've had people that, for example, had business went under, there were creditors that were being owed money, and there were multiple hits on the credit file. We actually told them, listen, and they thought, look, I'm out of the industry for 7 years, I can't borrow any more money. I said, no, that's not true. I said, we can write one letter, because it was commercial debts, we can write one letter substantiating what happened, it wasn't your fault, we did it, it went through, we got a non-conforming lender and they borrowed money and they're in the property market today. So it's very important to be upfront about it. Make sure you have a copy of your credit file. Make sure you go in credit alert. And make sure you tell your broker upfront, if you have a credit impairment, that you've got one. Don't leave it to the last second, because then you won't be able to settle the property and he'll have to do a different product with you. And clients do this sometimes, not knowing that they've got a credit impairment or hoping they'll get away with it. And then the day before settlement or a week before settlement, they get hit with a credit file check and we see an impairment, we say we can't put you through and we've got to refinance and look through another lender, and it's hard to do things in 1 week.